Applied Digital Corp, ticker APLD, is trading live on the NASDAQ at $29.305. That's a sharp drop, down $1.8305, or nearly 5.9% in the first hour of trading today, November 11th, 2025. The stock gapped down at the open to $32.17 after closing yesterday at $31.44, and it has been on a steady slide since, hitting a low of $29.25. All of this is happening on significant volume that is already approaching 24 million shares, on its way to a daily average that's been hovering over 30 million. Now, the immediate question, the one that should be bothering anyone watching this, is why a stock with a strong buy consensus from nearly a dozen analysts with an average price target north of $42 is falling off a cliff. The expectation, fueled by a stream of incredible news, is that APLD is on a rocket ship. The reality, at least today, is that rocket fuel is incredibly expensive, and the bill just came due. The reason for this painful intraday drop isn't a missed earnings report or a contract cancellation. It's the announcement from just yesterday, a proposed $2.35 billion offering of senior secured notes. This is the entire story in a nutshell. This is the tension that defines Applied Digital. The market has been treating this as a pure play on the artificial intelligence compute build-out, a company that successfully shed its skin as a blockchain infrastructure provider to become a critical partner for AI giants. And that narrative is correct. But what the market is being forced to choke on this morning is the staggering cost of that ambition. Building the AI factories of the future, these massive next-generation data centers, is one of the most capital-intensive businesses on the planet. And $2.35 billion is a massive number for a company with a market cap that was floating around $8.7 billion. So the expectation of smooth sailing, of just signing multi-billion-dollar deals and watching the stock rise, is colliding with the reality of high-yield debt financing in a complex interest rate environment. Short-term traders are heading for the exits, seeing dilution, seeing debt covenants, and seeing risk. Long-term investors, however, are likely looking at this as the necessary cost of entry to fulfill the very contracts that make the company so compelling. This is the kind of volatility that has traders glued to their interactive brokers terminals, while more passive investors in, say, Schwab Intelligent Portfolios would be terrified. Let's step back and look at the common ground. The narrative that got APLD from a 52-week low of $3.31 to a high of $40.20. This isn't Apple stock with a decades-long history and a fortress balance sheet. This is a high-growth, high-risk infrastructure play. The company, which many people still mistakenly associate purely with crypto mining, has engineered one of the most significant pivots in the sector. They are building from the ground up specialized data centers for high-performance computing, or HPC. This is the specialized infrastructure that powers the AI models everyone is talking about. The market woke up to this fact when APLD started announcing contracts that are almost hard to believe. They have an $11 billion 15-year deal with CoreWeave, a critical AI infrastructure provider, to deploy 400 megawatts of capacity at their Polaris Forge 1 campus in Ellendale, North Dakota. Just last month, on October 27th, the company announced it had achieved ready for service for the first 50 megawatts of this deployment. This is a massive milestone. It means they are not just promising to build, they are delivering. This is the reality exceeding the old expectation that they were just a crypto company with a plan. And it didn't stop there. On October 22nd, APLD announced another staggering agreement for a $5 billion 15-year lease with a U.S.-based investment-grade hyperscaler for an AI factory at their new campus, Polaris Forge 2, near Harwood, North Dakota. This is a $3 billion 280 megawatt project that they only broke ground on in September. So in the span of a few months, this company locked in an estimated $16 billion in long-term contracts. This is why the analyst community is so bullish. This is why institutional holders like BlackRock and Vanguard are in. And most tellingly, this is why Nvidia Corp holds a 2.94% stake. When the company that makes the chips essential for the AI boom invests in your data center, it's the ultimate validation. The expectation became that APLD was a golden ticket, a picks and shovels play that was more Nvidia stock than a speculative microcap. Now, let's challenge that. The reality check isn't just today's $2.35 billion note offering. It's been in the financial reports all along for anyone willing to look past the headline contract numbers. When the company reported its Q1 2026 results on October 9th, the story was clear. Revenue was fantastic, up 51% year over year to $63.9 million. This shows the growth is real, but the net loss was a staggering $138.7 million. Even the adjusted net loss, which strips out a lot of items, was $12.6 million or minus $0.06 per share. This is a company that is burning cash to build its empire. This isn't a criticism, it's the model. You cannot build billions of dollars worth of data centers without spending billions of dollars. This is why today's stock price action is so logical, even if it's painful for those holding. The $16 billion in contracts is the future revenue. The $2.35 billion in debt is the present cost, and the market hates paying the bill. This is a stock you buy on a Fidelity or SoFi Invest platform because you believe in the 5-year plus vision, not because you expect a clean linear move up. It's a bet on execution. Let's talk about that execution. The ready-for-service milestone at Polaris Forge 1 is the single most important bullish data point. It proves the team can build. The second is the plan for Polaris Forge 2. This is a $3 billion campus that will require immense logistical and financial coordination. The risk is enormous. What if there are construction delays? What if the cost of high-speed networking, power, or cooling components balloons? What if the counterparty, that investment-grade hyperscaler, finds a problem with the build-out? These are the risks that keep the short sellers interested. The stock's beta, a measure of its volatility, is incredibly high. It's not a stock for self-investing if you have a weak stomach. You are not buying a stable utility, you are buying a construction company in a gold rush. So here is the central tension as we look forward. The bull case is simple and powerful. APLD successfully places this $2.35 billion in notes, maybe at a better than feared interest rate. They use that capital to fully build out Polaris 1 and 2. The contracts with CoreWeave and the hyperscaler kick in, and revenue doesn't just grow 51%, it grows 500%. The massive net losses, which are mostly from construction costs and depreciation, begin to shrink as the high-margin leasing revenue floods the income statement. The company becomes a cash flow machine, and the stock at $29 looks like an absurd bargain. The analysts with $42 targets look conservative. The bear case is just as clear. The $2.35 billion note offering is a sign of a company that must have cash. This gives the debt holders all the power, forcing APLD to accept high interest rates that will eat into future profits. Perhaps the execution falters. The $3 billion Polaris 2 campus hits a snag. A competitor like Iron or CoreWeave itself builds faster and cheaper. Or, in the worst-case macroeconomic scenario, the AI compute demand bubble, which is driving everything from Tesla stock's self-driving ambitions to Nvidia stock's valuation, cools off. In that world, APLD is left with billions in debt and half-empty hyper-specialized buildings in North Dakota. This is the expectation versus reality framework in its purest form. The expectation is limitless AI demand. The reality is enormous execution risk. For traders and investors looking at this today, the decision comes down to time horizon. If you were day trading this on the Robinhood app, you're probably playing the downside momentum, looking for a bounce off the intraday low of $29.25. You're watching the level 2 quotes and the volume patterns, and you are terrified of this debt offering. If you are a long-term investor, you might be looking at this 6% drop as a gift. You're opening your Fidelity brokerage account or perhaps using SoFi Active Investing and thinking about starting a position. You are buying the $16 billion in contracts and trusting the management team, validated by Nvidia, to execute. This is the kind of stock that polarizes investors. It is the definition of a battleground. Here's a question for everyone watching. Comment below with your thoughts on this $2.35 billion note offering. Is this a smart, aggressive move to fund necessary growth? Or is it a dangerously large bite of the apple that adds too much risk? Ultimately, Applied Digital is a story of transformation. It's a story about the staggering, eye-watering cost of building the physical world that the digital AI future will live inside. The market's expectation was that of a flawless parabolic rise based on dazzling contract announcements. The reality, underscored by today's $1.80 drop, is that this is a capital-intensive,